The Australian housing market has many people scratching their heads. On the one hand, many analysts see great times ahead with double-digit capital growth predicted for some of our capital city markets next year. On the other hand, there are those who are convinced the market's in an unmistakable bubble and expect an eventual significant drop in house prices, which is going to leave all those ugly rich property investors nursing big losses. So are we in a housing boom or is it a bubble? I'm Michael Yardney and I want to explain to you that the bottom line is we're not in a bubble, but house prices are lifting from their troughs in the middle of last year. Look, to better explain to you why I think we're not in a bubble, let's just do a quick question and answers. First of all, what's happening to dwelling prices? The latest RP data report up to October this year suggests that we've actually got a rather tame residential market in response to favourable influences such as low interest rates and undersupply of new properties, strong population growth and rising consumer confidence. Now, the Sydney property market's booming, but if you look back over the last decade, Sydney home prices have barely grown in line with inflation. They've actually only risen about 2.5% per annum over the last decade. The next question you could ask is, well, what's actually happened since the market bottomed in the middle of last year? If you go back a bit further, in general, home prices dropped in 2011. They bottomed in the middle of 2012 and eventually started retracing as investors and home buyers embraced the attractive market conditions and got confidence with the good economic conditions. However, if you look at how in previous cycles the property market grew, specifically 2001, 2007 and 2009, the rise in values over the 17 months after the market bottomed is significantly more modest this time than in those previous growth cycles over the last decade. In other words, sure, property prices have gone up, but not as much. Now, of course, we're experiencing amazing growth in Sydney, but it's just overall the normal machinations of the property cycle. What happens is property values rise for a while and then they get to be too high, so they slow down or slump, then they retrace and they finally go into the next expansionary phase. So we have now retraced our property prices and just hit the rise at the top of previous cycles, and now we're going into the expansionary phase of the property cycle. Current property price growth overall in Australia is at about the 6% per annum mark. In fact, that's in line with their long-term averages. Sure, property prices are up about 9% from the trough of the middle of last year, but in general they're only up about 1% on the previous peak, which is late 2010. And most of these gains are concentrated in Sydney, where in fact prices haven't changed a lot since 2004. They're also up in Perth, where we've got strong population growth. But when you dig deeper, price growth in the other capital cities and in regional Australia is more restrained. But some people are saying house prices are expensive. They're too expensive in Australia. Yes, house prices are expensive by world standards, but this is a reflection of the fact that most of our population is concentrated in a few capital city locations and they're coastal locations. Also, we have high quality, large housing stock, generally on big blocks of land when you compare to overseas. Adding to that, the poor state of the public transport in our big capital cities only increases the premium people are prepared to pay living close to the CBD. Of course, this has some bubblers saying that house prices are now overvalued because the rise in house prices over the past few decades vastly outperformed the rise in wages. This overlooks the fact that there was a once-off historic boost to household borrowing capacity. See, in the middle 1990s, they halved interest rates when the Reserve Bank started to control inflation. This, in effect, halving interest rates doubled the amount of money that households were able to borrow, given the same amount of income. At the same time, there was a relaxation of lending standards by banks in response to financial deregulation. So this increased the amount of money banks were willing to lend against that income. So lower interest rates, better lending criteria are largely responsible for a big increase in household debts in the 1990s and the 2000s. However, some bubblers are still convinced that debt levels are unsustainable and some shock will happen and the bubble's going to pop. They're saying, well, look, what about all this credit growth? Sure, credit growth has grown, but bubblers say that if more people are taking on all this debt, they're becoming heavily leveraged. A sudden change in the outside world, it could be a problem with the economy, it could be unemployment, it could be interest rates, that would suddenly make all these property owners who've got all this debt struggle to repay their debt. The fact is, our low interest rate environment is not causing a strong rise in credit growth like some of these bubblers are saying. Sure, credit growth has lifted off its historic lows, but it still remains relatively soft. In fact, credit growth only grew about 4.7% in the last 12 months. Part of the reason credit growth is slower is because about half of households are not reducing their regular mortgage payments as interest rates fell. In other words, they're still making the same payments, putting them way ahead on their mortgage payments. Another factor is banks' high lending standards. If you compare them to the lax standards overseas, those standards that led to the housing meltdown in the United States, we're in a great position. So some people are asking, well, is the Reserve Bank worried? They don't seem to be concerned by what's happening to property prices. In fact, nor should they be surprised by our rising house prices. In part, it's the Reserve Bank's plan to rebalance growth as our mining boom fades. The mission has been to stimulate our economy, and in particular housing activity, so they must have expected some sort of price impact. Recently, Dr. Lucy Ellis, the head of the Reserve Bank's Financial Stability Department, reaffirmed the Reserve Bank's position. They said we're not in a housing bubble. She said, yes, Australia did actually come close to a housing bubble about a decade ago. But in her words, on the basis of dispassionate analysis of the data, there was no comparison with the current state of the market. Well, is the government worried? If you've been reading the papers, you'll see recently Prime Minister Tony Abbott and Treasurer Joe Hockey explained how rising dwelling prices are generally a good thing for Australia, considering the wealth effect that we get when our home values increase. So think about it, what could cause our property markets to collapse like some people are worried? It's not as simplistic as some bubblers think. House prices only fall when people are forced to sell their homes. Sure, the market's going to turn again one day, but that doesn't mean property prices will collapse. What tends to happen is people just simply choose to remain in their home and ride things out, and property investors try and hold on rather than realise a capital loss. So a true collapse in house prices would require some large external event, some shock, such as high unemployment to trigger a wave of forced sales. While unemployment is likely to creep up a little bit, no one is suggesting we're going to have crippling unemployment in the foreseeable future. The other shock that could cause a property collapse would be high interest rates that would cause a raft of homeowners to default on their mortgage. Again, this is unlikely in the foreseeable future. A third thing that could cause property markets to collapse is a recession that would cripple our economy. But if our politicians play their cards right, that's really unlikely. Or the fourth factor, I guess, that could cause a property market to collapse is a severe oversupply of property. Now, this could occur in a few isolated markets, but generally, in Australia, we've got an undersupply of properties. So in summary, an improvement in the interest rate sensitive housing sector is critical for Australia to successfully rebalance our economic growth away from the declining mining investment boom. As part of this, house prices need to rise to help boost household wealth and support consumer spending. More importantly, the Reserve Bank wants this to occur to encourage an upturn in the housing construction cycle. Sure, Australian housing is already amongst the most expensive in the world, but just because something is expensive doesn't mean it's in a bubble. Property values are only just back to where they were 3 years ago. Where will they be next year or the year after? Who knows? I don't have a crystal ball, but the fundamentals suggest we're at the beginning of the next expansionary stage of our property cycle. And that's most likely going to last a couple more years. On the other hand, if property values do keep rising the equivalent of 20% a year, as has happened in Melbourne and Sydney over the last quarter, then this cycle is likely to be much shorter, and once again values could fall. But they're unlikely to crash. What's most likely to happen is that growth will slow a little bit in Melbourne and Sydney. At the same time, as our economy gets stronger and house prices rise a bit more, the Reserve Bank is probably going to put some hurdles in the way. They're going to raise interest rates, and that will slow the cycle down. However, property prices are not going to crash. In fact, according to John Edwards, founder of Residex, we haven't had a property market crash in Australia since 1890. So what are you going to do about it? If you want to take advantage of our growing property markets, why don't you take a look at what your options are? And if you are looking at those, why don't you get the independent advice from the team at Metropole? Metropole Property Strategists are a multi-award winning team with offices in Melbourne, Sydney and Brisbane. We've got no properties to sell, so our advice is unbiased. Whether you're a beginning investor wanting to get into the market or a serious professional, we'd love to help you formulate an investment strategy or review your current portfolio. Just click on the link below and go to our website or ring 1300 20 30 30. Come along and have a free property review. I look forward to bringing you my next update with my next newsletter.